Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and welcome to this panel session for our 2024 income series. I'm joined by two wealth managers who are going to help us talk about the factors that are influencing their portfolio construction at the moment, some of the opportunities on the income front, and also a few of the common mistakes that they see to help you keep your portfolio looking very tidy. I'm joined by Alexandra Kalsev from Wilsons Advisory and Stephen Cabot from UBS. Welcome to the show.
Thanks for having us.
Stephen, I'm going to kick it off for you. What are the top 2 or 3 factors influencing your asset allocation as you look out over the next 12 or 24 months?
Yeah, and we're starting with taking a look at the macro picture, seeing what's going on in the world. We're of the view that growth is likely to slow down a little bit further from where we find ourselves today. Inflation, which has been the pest of economies globally, is something that we still think is heading in the right direction. There's been a lot of persistence there, and we're still getting a few reads that are higher than where we would like. But we think that will come under control between now and broadly the end of the year, getting towards those central bank targets. And that frees up central banks to be doing a little bit more on the monetary policy side. For equities, look, we're broadly constructive. We're a little bit cautious around some of the valuations we see out there. However, very comfortable to recommend to clients to be invested. We've just come through another reporting season in the States, which has been quite robust. AI is still very much a flavour of what's going on and is seeing incredible cash flow and profit in the big names in particular. So that's there. Our preference is for fixed income over equities, and that's on a risk-return basis. We just think the way things are stacked at the moment, we can generate some pretty stable returns from fixed income and single-digit returns, and we probably expect the same from equities. It's just that risk-return trade-off means that bonds look a safer place.
Okay, Ali, same question to you. What are the things that impacting your thoughts on asset allocation the most at the moment?
Yeah, absolutely. Very similar views to Stephen in that, once again, inflation and interest rates are dominating conversations with clients at the moment. We also think that the next move from central banks will be down. It's a question of when, and really those views have shifted so much this year. At the start of this year, markets were pricing in 6 cuts in the US, and we're down to 1 now. Fully by the end of the year, and there's even been talk of potentially a raise here in Australia. That's not our base case view. Our view is that Australia will be behind the US, maybe first quarter next year. Growth in economies is slowing, and we are also nervous about valuations. However, as interest rates come down, that will be supportive of markets as well.
You've both mentioned equity valuations as an area of caution. Are there any specific equity markets that you think look more overvalued or that you have more of a disposition towards?
I think the Australian market is pretty challenged, with the majority of it being mining and banks. I think there are headwinds facing both of those industries, particularly if interest rates remain high. In the US, the growth has really been very concentrated, and so nervous about what's being priced in for those businesses, although we had NVIDIA report this week, and once again they've done very well.
Isn't it? Stephen, I'm going to switch it over to you. Last time you and I spoke, it was actually in the depths of COVID, which if you cast your mind back, 0 interest rates or near 0 interest rates, equities or TINA was like the catchphrase of the moment. It's quite a different environment right now with interest rates, in a completely different sort of part of the curve. How's that impacted where you're finding income opportunities and where you're putting money to work?
Yeah, and it's had an enormous effect, James. I was looking back 10 years ago, so 2014, interest rates in Australia, the RBA cash rate was 2.5%. You have to go back to 2011 to find something in the sphere where we are today at 4.35. And we in COVID, probably when we spoke last, we're 0.1. That's very, very low expected return from fixed income, and we find ourselves today in the space where we can generate a great return for clients in that fixed income area, and on a risk return basis, it stacks up quite nicely. So we have been talking to clients a lot about that. In investment grade bonds, you're talking 5 to 5.5%. If you step up or down the capital structure a little bit further, and the subordinated area, you're talking about 5.5, over 6% even is something you can quite easily get, and clients are much more engaged talking about those returns than what they were in COVID. It's interesting as well that one of the other attractions of fixed income, which certainly wasn't present in the last 3, 4, 5 years, it was the correlation with equities, and we rely on fixed income to give that buffer. So, you know, if equities are falling, bonds can give some support to the portfolio, and when rates were so low, that was very hard to deliver. But we're at a point of the cycle now where that is back in fashion, back in play. So we think you know, the next move by central banks is likely to be a cut. So there's capital appreciation, you're getting your return, and the ability, should we get a geopolitical shake-up or just an economic challenge, and the markets do have a bit of a crisis moment, then the fixed income will offer some support. We've just published our 2024 Global Family Office report, and in that we've seen that the shift that we're talking about of moving from, you know, the risk assets to fixed income. Globally, this was with 320 families that had net worth of 4 billion Aussie dollars, so some very significant family offices. But they have significantly shifted back into fixed income, and that's what we're seeing from our client base as well. So they had 12% at the end of last year, and that's jumped to 16% this year. So a reasonably significant shift that we're seeing throughout the client base.
Ali, same question for you. You know, how has it changed the way you're putting together portfolios compared to that zero interest rate environment?
Yeah, absolutely. Fixed income is the asset class we've been speaking about mostly, and I think in addition to the public markets, we're now talking a lot about private market fixed income. So private debt is now prolific in the industry. The number of new entrants has been incredible, and there's been a structural shift there with the banks pulling back on their presence in that market. But really, we haven't seen this surge in corporate lending. We don't think there's a bubble, but I think it's important to be quite discerning in where you're investing your money in that space.
Yep. How much of a typical portfolio that you look at would be allocated towards the fixed income in the current environment, and maybe across those spectrums that Stephen mentioned before?
So speaking of a relatively balanced investor, there'd be 15 to 20% in fixed income and perhaps another 5 to 8 in private credit.
And the remainder in a balance of global and domestic equity? 30%
defensives, of which both of those are a part of that, and then the balance of 70 odd towards domestic, international and growth alternatives.
Yeah. Stephen, same question for you.
Yeah, and maybe it's the Swiss banking. Our profiles tend to be a little bit more conservative, and we probably have a little bit more in the fixed income. And that's, you know, if we've got a sort of 35% base case in fixed income, we're overweight that. So we're probably up around 40% there at the moment, with probably around half, 50% in equities, and then alternates. And the alternates is where we include the private debt, which is very topical, and also some real estate infrastructure and hedge funds as well. And at the moment we're very strongly advocating diversification as key. We're overweight fixed income. Equities, we reasonably confident with and want to be involved. However, we want to make sure that if valuations get checked, you don't want to be overexposed. And so the private area is something, and the alternates is an area that's getting a lot of attention in client discussions.
I want to dive into an area that I find there's often a lot of debate around the approach, and that is total return versus this more harvesting style approach to generating income. Is there a risk, do you think, that with the higher yields that people get too fixated on just trying to harvest? And how do the conversations go when you speak to clients about that particular, the mentality around investing? Ali, I'll start with you.
Yeah, sure. I think it's a really important discussion to have. There are a lot of interesting headlines for yields, but what you need to understand behind that is what's the risk that's associated with that. And so if we perhaps look at equities, Australian equities has been an interesting part of the market for yield, but a company that's paying very high dividends, of course, can mean that they're unsustainable and they're about to be cut, or that the business isn't investing in growth. And therefore, if you're investing in an equity just for income, what's the risk you're taking on? So you should really look at fixed income then, where you're not expecting much capital growth potentially, but at least you are better protected from a risk perspective.
More confidence in the sustainability of the income.
Yeah, that's right.
Stephen, anything to add there?
Yeah, so I guess the other point that would be part of the conversation too is understanding that the time frame a client's got to think about these things. The shorter the time frame, I think the more income certainty or comfort you want to have. And so that's where, if it's a real short-term sort of liability, cash term deposits is going to make, the most sense. Beyond that, you probably start stepping into fixed income to get your coupons. But if you've got a reasonable time frame and you've got the risk tolerance for it, you've got to make sure that you are getting some of those other asset classes, be it the private markets, the private debt. And equities, I think, are generally always going to be a pretty important component. And we're spoilt in Australia by our dividends that we can get, and that can be an attraction. But certainly, caution needs to be exercised when focusing on that primarily, as Ali mentioned. It's great to get good dividends, but you want to keep the value of your corpus sort of running pretty well.
Yeah. Let's get into some specifics. What are a couple of the asset classes that you think offer standout opportunities from an income perspective at the moment? Ali, I'll kick off with you.
So fixed income is certainly where we have our biggest overweight from an asset allocation perspective. We focus primarily domestically. We think that spreads look interesting here, and in an environment where policy rates will be higher, the spreads in Australia are pretty attractive.
And is that, in terms of along the yield curve, is it shorter dated, longer dated?
Generally shorter dated.
Yep. Stephen?
Yeah, it looked reasonably similar for us as well. Like the investment grade space is where we're encouraging clients to look a lot, and the shorter tenors probably is something that we're very mindful of. In terms of making sure that we've got a few areas covered, though, that is where we talk about the diversification, the private debt. It looks interesting, as Ali points out. It was the regional banks in the States, we've probably set off the opportunity in a structural sense for a lot of the change here, and Silicon Valley Bank was highlighting that the challenge of asset liability mismatch when a lot of cash deposits flew out and they had these long dated assets, and so that's led to the regulator changing the rules, and so banks are stepping back from a lot of that, opening the opportunity for private credit. The key, I guess, concern or the point we like to make for clients is just be aware these also are not liquid securities all the time. They do. A lot of the offerings at the moment do offer the opportunity for liquidity, but we need to be aware that can seize up at some point, and we want to make sure that we're not exposing too much of a portfolio to that area. But you can generate some very attractive returns in that area. You're talking double digit in a lot of cases, which is very attractive in this environment as long as the liquidity is considered.
Yep. And you're understanding what you're actually investing in. Yep. No credit is the same, but being aware of actually what risk is within those portfolios is critical.
Yep. Are there any go-to funds or ETFs that feature heavily in the portfolios at Wilson Advisory?
Yeah, sure. Seeing as I spoke about fixed interest, I'll put forward one of my preferred, which is the Yarra Enhanced Income Fund. Yep. So that fund, it's been around for 20 years now. Over every period, it's outperformed its benchmark. What they do is focus across the capital structure of corporate credit, investment grade, and they're very dynamic. And why that appeals to me for my clients is that it's something that we can't do on their behalf. They've got the scale and the access and the expertise. And also it's a very investor-friendly structure, so they pay monthly distributions to clients. Yep. So we're able to benefit from those attractive spreads I mentioned earlier in a neat investment vehicle.
Now, as much as I'd love to be talking about the fun stuff, the earning the income, there are considerations around tax that I think investors need to be aware of. What are some of the guiding principles that you share with your clients, just to make sure they get their money working as hard for them as possible? Yeah,
sure. So I do want to put the caveat out there up front that I am no tax expert, but it is incumbent on us to consider tax in sort of a lot of our conversations, involve the tax accountant or a specialist in that area. But there are a few key things that we're always looking at and considering. Firstly, what structure are we talking about that the clients are investing in? Is it a corporate trustee? Is it a trust? Is it a superannuation fund? Is it in retirement phase or accumulation? And that's going to have a bit of an influence on how we might think about structuring portfolios and conversations. Also, if we're talking about, are we investing in securities that are entitled to a capital gains discount? If we hold them for the long enough period. That's going to be an important factor. Franking credits for Australian investors, obviously, the value of being able to claim back the tax that the company's already paid is quite relevant and a key determinant of some things that we do. But we never let the tail wag the dog, I guess, is making sure that holistically, structurally, we've got a portfolio that makes sense, and then we can figure out about how to think about tax.
Yep. Ali, anything to add to that?
We take a very similar approach, and I'll give the same disclaimer that I can't provide tax advice. But before we have any conversation with a client around investments, we speak about the right structures, entities, and make sure that they're getting the right professional advice.
So get it done up front.
Absolutely.
Rather than try to fix it afterwards.
It makes things a lot easier when that has been done up front, and then you haven't got to try and move things later on, which can be painful.
Ali, could I get you to share 2 or 3 common mistakes or misconceptions that can harm investors' returns?
Yeah, I think that there are a couple of things here. So one would be really understanding the risk within an investment. As we spoke about earlier, seeing an attractive headline return number is fine, but if the risk you're taking on is significant, then those total returns might not actually be there. From a broader perspective, I think it's important for investors to realise investments as we go. Often they don't
take some money off the table.
Absolutely, realise profits as you go and risk weight that position. It's easy to hold on to the winners and perhaps not to cut the losses of the losers. So not be wedded to a position is probably the way of summarising that.
Okay. Stephen?
Yeah, look, 3 things I'll quickly touch on. The first one is don't get fixated on the income number. I think total return can be more relevant in thinking about it. Now, some people do love the income coming in, which can be important, and there can be reasons to think about that. But the total return is ultimately what is going to increase the wealth, and you can draw on that if needing some income along the way. Secondly is not neglecting growth assets. If someone even hits retirement, at 65 or thereabouts, you're talking about 20 years to live. It still makes sense to include some growth assets if you've got the right risk temperament to be doing so.
I mean, it's interesting. We had a look at 12-month returns on the ASX, global equities versus cash, and whilst the term deposit rate's attractive at 5%, Australian equities did 12 to 14% over the last 12 months, and global equities closer to 20%. Yeah,
and that's the third point I was going to mention is cautious on home bias, but coming back to the returns, I looked at the 10-year returns, and if you look at the ASX, which pays a very nice dividend along the way, somewhere in the 4.5 sort of range, the total return over the last 10 years has been 9.7%. Now, you'd take that any 10-year cycle, I think you could. But if you look at what the MSCI World did, that was 12.7%. And then you look at the S&P 500, I think that was 16.7%. So there's a big world out there, and that's not always going to be the case. They're not always going to outperform. But it does make sense from a diversification perspective to include those to get access to sectors, corporates, regions that we're not going to get in Australia.
So don't neglect those growth opportunities.
Absolutely.
Okay. Well, Stephen and Ali, thank you so much for coming in today. It's been a pleasure hosting you as part of our income series this year.
Thank you.
Thank you, James.